Hi, this is Roger Michalski, publisher of Eagle Financial Publications. We are now in video 4 of our Covered Call series with Brian Perry, the editor of the Cash Machine newsletter. So Brian, one of the things I think people want to know about is what type of account do they need to do this covered call strategy?
Well, any account will work, Roger. Some are more favorable than others, but you can basically deploy a covered call strategy through cash accounts, margin accounts, retirement accounts, and even some 529 accounts will allow for that kind of management tool as well. It's considered to be such a reduced risk type of management tool that it's about the only option strategy that's a blanket, what they call level 1 approval for most accounts. So you can have almost no experience at all investing and still be approved for covered call writing. So that just kind of gives you an idea of how much the brokerage firms and the compliance departments of these places think of covered calls, simply because you're not taking on risk, you're selling risk. Mm-hmm. And really that's the larger mechanic behind it all. Retirement accounts make more sense, simply because the income you're generating from covered calls is taxed at ordinary income rates, okay? Unlike qualified dividends, which are 20%, and then holding long-term capital gains, which are taxed at 20% also. In a covered call strategy, there's the risk of having your stock called away from you if it trades higher than where you sold that right to have it to bring in that covered call premium. So for investors that have a very low cost basis, that they've held stocks for years and years and years, may want to consider not writing covered calls against those positions where they would incur a very large capital gain. But at the same time, in retirement accounts, it's pretty much a very favorable strategy from the standpoint of, the only tax you incur is when you take out money out of your IRA. It really doesn't matter how that money is generated, whether it's short-term, long-term, qualified income, or just from option income related. So ideally, you want to have an active covered call program in your retirement account, but it doesn't mean you can't also do this very effectively in a cash account as well. But simply know that you got to watch your cost basis if you've had or inherited stock that has a very low basis.
All right, so you can do it in any kind of account, but it's better to do it in a retirement account to keep it away from the government then. Basically.
Exactly, that's always a good idea.
Yeah, always a good thing.
I'm with you on that. Yeah.
So thank you, Brian, for that. And on our next video, I'm going to ask you to actually walk us through an example on a whiteboard. So can you do that for the next video?
Would love to, thank you.
Okay,
yeah.
Great. Well, look forward to video number 5, and Brian will walk you through an actual example.